Good afternoon and welcome to the first webinar of the year by Bartley Tredegar Securities. To begin, I would like to wish everyone a happy new year, and we hope the year ahead brings brighter beginnings, steady growth, and meaningful wealth creation for our investors. Rebuilding Sri Lanka is now moving to a new phase. As we look ahead to 2026, the focus for investors is shifting from stabilization to selective opportunities within the equity market. Today's session will discuss the macro outlook for 2026, how it supports a selective equity strategy shaped by selectivity, discipline, and forward-looking positioning. To begin, Mahesh Vattagedara, our economic analyst, will open the session with the macro outlook for the year, covering growth, inflation, interest rates, and key risks shaping the rebuilding phase. This will be followed by the equity strategy session by Hesha Charmika, and our research analyst will then take you through their respective stocks, translating our strategy into company-level insights. Please feel free to send in your questions using the Q&A box at any time, and we will take them up after the presentations. Over to you, Maheshi.
Thank you, Shalini. And good afternoon, everyone. I'll start off with the BRS economic outlook. So the economy, if we are talking about the Sri Lankan economy has moved beyond the crisis management into a phase of stabilization and some kind of selective recovery. So, however, with the recent shocks, particularly with the recent cyclone, remind us that the path forward will not be linear. So today, our focus is therefore not just on the growth numbers, as Shalini said, but on where earnings visibility is improving and where risks remain and how investors should position portfolios in this environment. With that, let me start by walking you through the key economic developments shaping our economic outlook. Okay, let me start with the growth. So Sri Lanka's national output in 2025 outperformed our initial expectations, supported by rebound in economic activities under the backdrop of political stability and other macroeconomic developments. So despite the disruptions caused by Cyclone Ditwa during the latter part of the year, we estimated real GDP growth at 4.5% in 2025, reflecting stronger than expected performance across the board. However, looking ahead in 2026, growth is expected to be moderated, primarily due to the weather-related supply disruptions. Especially the agriculture sector is projected to be subdued, reflecting this cyclone-related losses, especially in the first half of 2026. However, having said that, we do not projected the growth slowdown to be a broad-based slowdown. So we expect industrial activities to remain resilient, and especially with the rebuilding and construction sector is expected to play a central role in post-cyclone economy. In addition to that, service sector also expected to remain robust. So considering all these factors, in overall, we forecast GDP growth of 3% in 2026, followed by a modest recovery of 3.2% in 2027 as rebuilding activity and sectoral resilience take hold. So with that, let's move on to the inflation. So the same supply disruptions I mentioned for the growth outlook weighing on pushing inflation higher. Especially if we take the food inflation is rising due to the post-cyclone supply shortages, while energy price pass-through remain a risk under the cost-reflective pricing mechanism. In addition to that, we observed there can be wage pressures, including minimum wage revisions, are structurally lifting the services inflation. So as a result, considering all these factors, we project headline inflation at 5.8% by the end of 2026, which is kind of above the inflation target of 5%. But going forward to medium to long term, we expect inflation should gradually converge back to the target level as supply shocks fade and policy credibility holds. With that, let's move on to the external sector. So I'll start off the external sector with the merchandise exports and imports. So external sector also, we expect the sector to face some near-term headwinds, especially if we take the merchandise exports are expected to remain some kind of weak in 2026, reflecting again this cyclone-related agricultural losses and logistical disruptions. At the same time, if we talk about the merchandise imports, we expect import bill to rise in 2026, driven by reconstruction needs and food security requirement. And moving on to service exports, service exports will grow modestly in 2026. However, it will constrained by temporary disruptions on tourism and transport disruptions. And talking about the medium to long term, we expect rebound in 2027. However, structural trade constraints continue to cap medium-term upside. With that, since we talk about service exports, let's talk about the tourism as well. So we had a record-breaking year in 2025 with 2.3 million tourist arrivals. So going forward, also we expect this momentum will continue. However, there will be short-term shock with this cyclone happen at the beginning of the peak tourism season. But in medium to long term, we expect tourism sector to be strengthened. So especially if we talk about the 2026, this cyclone-related infrastructure disruptions will moderate arrivals, but we can observe that underlying demand remains strong. Therefore, we project tourist arrivals to exceed 2.5 million in 2026, supported by regional demand and improved connectivity. In addition, also we talk about the arrivals. If we talk about the earnings, so being a critical foreign exchange earner of Sri Lanka, the tourism sector, the tourism earnings expected to be remain around 3.4 billion in 2026 and to reach to around 3.6 billion US dollars in 2027. And with that, let's move on to the remittances. Again, one of the major foreign inflow of Sri Lanka. So remittances provide a structural buffer for the current account of Sri Lanka, which offsetting the trade deficits and supporting the external resilience. So remittances are now transitioning from post-crisis surge to a kind of a stable, steady state according to our projections. So we expect inflows to remain around 8 billion in 2026 and 2027. So according to our estimations, we estimated around 7.8 billion earnings in 2025, the last year. So this year and next year, we expect it to remain around 8 billion with the Middle East continuing as the dominant source. With that, let's move on to the gross official reserves and exchange rate. So when we're talking about official reserves, so these external buffers continue to rebuild gradually. So according to our projections, gross official reserves are expected to be remain around 7.7 billion US dollars by the end of 2026, supported by all these external inflows and central bank purchases. And when we're talking about the exchange rate outlook, so the exchange rate is expected to depreciate gradually, reflecting this reconstruction-driven imports, as I mentioned before, and external risk management. And with that, let's move on from external sector outlook to interest rate outlook. Given the inflation risk, we expect an extended pause in policy rates to 2026. And with the potential exchange rate depreciation pressures, as I mentioned in the previous slides, and that with the rise in inflation expectations, they might require moderate policy tightening, I would say, of around 25 basis points in the latter part of 2026, according to our expectations. But overall, in our base case view, we remain that policy rates will largely be maintained supportive for equities. And moving to our 2027 expectation, we believe that policy easing may resume in 2027 as inflation moderates towards the target and supply conditions improve. Yeah. Moving on to private sector credit growth after interest rates, let's move on to private sector credit growth. So according to our forecast, private sector credit growth of we expect around 11% year-on-year growth in private sector credit in 2026, driven by working capital demand and expansion across industry, services, and households. And also with the improving business confidence and asset quality are particularly supportive for financial sector re-rating according to the data available. So we believe that this credit growth, private sector credit growth, is now a key engine of the next recovery phase of Sri Lanka. So with that, those are the major things we want to explain you regarding each economic indicator. So this is kind of a summary of our expectations on each key economic indicators. We compared it with IMF projections here, if you can see. You can see apart from a few economic indicators such as gross official reserve levels, all the other indicators, our projections remain broadly in line with IMF projections, but you can see slight changes according to our models. And with that, if we move on to see how the macro insights for equity positioning, what I can tell you here is the earning momentum is strongest in industrials, construction, and services, supported by reconstruction activities, easing interest rates, and improving credit conditions. Most importantly, macro stabilization through lower inflation volatility and more stable exchange rate is improving earnings visibility and supporting investor confidence. So we haven't said that still we have risks remain such as climate-related shocks, fiscal slippage can be happen, and external volatility is there, and policy execution risk is there, which will continue to cap a full market re-rating. So with that, to sum up the Sri Lanka's economic outlook, so what we can tell you is that the economy has shifted from crisis stabilization to a phase of moderate, more resilient growth, even in the face of recent climate shocks. So while the near-term momentum is softer, according to our forecast, underlying macro stability supported by policy discipline, rebuilding activity, and steady external inflows provides a firmer foundation than in previous cycles. So with that macro context in place, so we can now turn to see how those conditions translate into the equity market. Thank you.
Yes, thank you, Maheshji. And with that, we move on to our equity strategy session next. And Heshan Shamika, our equity strategist, will outline our strategy, including the valuation themes and the sector positioning. Over to you, Heshan.
Warmly welcome to BRS Equity Strategy 2026. So our strategy for 2026 is based on 4 key pillars. The first one, we see a short-term setback or a shock to a selective recovery. So it's not a broad-based boom. It's more of a reconstruction-led, a sector-oriented recovery, and there will be earnings reordership that we will see. And the second one, the equities continue to remain favorable for investors as an asset class. We will see why is that the case. And the third one, earnings reset and the growth resumes. Finally, the valuation remain attractive from the historical averages and also in comparison to the regional peers. Considering all of these, we recommend a selective overweight and arrive at a target price of 23,500 for ASPI for 2026 and 27,000 ASPI for 2027. So Cyclone Ditwa, it was quite the shock from a macro point of view. And while this is likely to lead to short-term earnings setback, it also kind of reorder the earnings contribution coming from different sectors to the market. So in our view, we believe that the fourth quarter earnings of 2025 and the first quarter earnings of 2026 will see a slight dip. However, there will be a pickup in the second half of 2026, as you can see in the numbers here. Traditionally, the fourth quarter and first quarter are seasonally strong quarters, but even from that angle, you will see a slight dip because we believe that the impact of Cyclone Ditwa will be mostly visible in the next 2 quarters. So still, if you look at the overall asset classes, the equities continue to generate superior returns in comparison to FD. You can see the outperformance of ASPI in the last few years, and also you can see the turnover levels that are sustained within the market. In fact, if you look at last year, that is the highest annual turnover that Colombo Stock Exchange recorded in a year in the history of Colombo Stock Exchange. So that says something. And we have seen, at least on the few days that we have seen January, the turnover levels are going to be sustained at these healthy levels. Then if you look at the earnings, yes, you may not see the annual dip that we can expect from any kind of shock. However, what we believe is that the short-term impact coming from Cyclone Ditwa will be reflected in the fourth quarter 2025, and the first 9 months was quite strong. And leading into the 2026, the first quarter is likely to be reflected of the majority of the shock. Still, you can see a 10% year-on-year growth or annual growth in 2026 and a slightly accelerated growth of 14% to LKR 872 billion in 2027. That is likely to keep the forward valuation intact. So how this translates into ASPI projection? At a justified P of 11 times, in line with 10-year average of 11.1 times of CSC, applying that onto the forecasted earnings of 765 billion in 2026, we arrived at the ASPI of 23,500. So it's clear that it's more about direction. It's just that, 2026 going to be the transition year again from a setback, and 2027 you will see the majority of the upside being reflected in the earnings in next year from this year. And this slide is quite important. What we want to evaluate, what we want to highlight the ranges from different re-rating scenarios. In our view, from different scenarios, we believe that the ASPI could range from 20,500 to 25,750. So the bull case or the best case scenario from our view is a 12 times. At least it's giving a certain discount to a significant discount to the regional peers. but a slight premium to their 10-year average, that is 12 times, and this 21,500, that is giving a 10-time multiple, which is in line with the 5-year average, where we had the most distressed market valuation in the near term. So in that sense, we expect 21,500 and 25,750 for 2026, and next year 24,500 and 29,250. Those are the ranges from a lower level to high level. So this is a reflection of our recommendation. As we promised last year, we are keep evaluating the performance. So the second half of last year was slightly sluggish for BRS index. However, still we generated 40% annual return in the last year, slightly below than ASPI. The second half was a bit volatile, and there was a little bit of a skewness on several stocks that lagged our performance. And considering that underperformance and the selection drag, and looking at the current macro environment, we have mostly skewed our portfolio, and the new additions come from construction and related companies. So you can see the Access, ACL, Sierra, Central Industries, Tokyo, and the likes of Pygmy coming into the BRS portfolio or the BRS index. And the exclusions are the likes of CCS, LB Finance, JK, Sunshine, CTC, TJ, Sampath, Expac, and Glass. So as I pointed at the beginning of the equity strategy, it's more about being selective and picking up the current momentum and the stocks that are tend to benefit from the current situation. Because of that criteria, we have rebalanced our portfolio to deliver better returns in next year as well. So what are the systematic risks for the market? These are some of the key risks we have highlighted. Any kind of fiscal slippage materially, and funding deposits. If there is anything to have, if the reconstruction spending tend to go overboard, and the inflationary pressures higher than expected by our economists. If that is to happen, whether that could lead to a monetary tightening situation earlier than what we are anticipating, could be a threat to the overall equity market in the sense of keeping the momentum halted. So with that framework, this brings us to the BRS recommended portfolio for 2026. I want to highlight these are the positions we have recommended as an overall portfolio. So keeping that in mind, we have only selected stocks to give in a balance from different sectors and to consider the current macro environment. So we have many more stocks under our core coverage. We haven't included all of them as a list. What we have done is we have built a portfolio where we have give a bit of a higher exposure to the construction and related companies. So when we release our strategy report as of 31st, based on the market prices of 30th, only whole recommendation was Chevron Lubricants for a dividend player. Others are pure capital gain recommendation, more than 15% upside. However, the recent price increases have brought some of the recommendation into a hold stance. Anyway, the construction picks are there: AEL, ACL, Sierra Cables, Central Industries, Tokyo, both voting and unvoting. And then the HEMAS, CIC, and the distilleries for the consumer picks, which are consistent and strong as they go into the medium to long term. Then we have reduced the exposure a little bit on the banks and NBFI, primarily because of keeping a timing stance, where we believe that maybe slight provisioning pressure will come in the first few quarters. Because of that reason, and to build into the team of reconstruction and rebuilding, we have reduced the exposure slightly on the finance companies, but we reiterate the attractiveness of both these sectors for the medium to long term. Then the individual stock selections like of ACAP, Pygmy on their own rights, and then the Chevron Lubricants as a dividend player. So with that, I will now invite to our expert specialist analyst on their respective sectors and the stock counters to bring in the investment thesis, and we'll start with the construction and related companies. And to start with, over to you, Maheshi. We'll start with Access.
Yes. Starting with the construction sector, with Access Engineering. So, regarding Access Engineering, our outlook remain positive, underpinned by post-cyclone reconstruction and the resumption in public sector projects, as I mentioned in our macroeconomic outlook as well. So, cyclone, if we talk about, they have several sectors. They are present in several sectors, mainly in the construction and also in the automobile segment. So when we're talking about the construction, civil engineering sector, the cyclone-related reconstruction supported by government funding and international aid is driving civil engineering activity and strengthening order inflows and earnings visibility. And when we talk about the construction materials, that segment is said to benefit from both reconstruction demand and the broader construction rebound. Meanwhile, easing import restrictions and replacement demand are supporting a rebound in the automobile segment, underpinning stable medium-term earnings. So with that, we recommend a buy with tentative target price of 97 rupees for FY27, implying around 25.5% upside based on our adjusted PER valuation. So with that, we can move on to the other stocks as well.
Thank you, Maheshi. Good afternoon, everyone. As you can see here, our next pick is Tokyo Cement Company Lanka PLC. So basically, we initiated the coverage on Tokyo Cement in November before Cyclone Tilka. After the cyclone, the situation changed. Due to expectation of a surge in cement demand from rebuilding activities, our initial target prices were already achieved for both voting and non-voting shares. So under the current environment, with rebuilding activities now coming through, we have revised our target prices. Our new target prices are 142 for both for the voting shares and 120 rupees for non-voting shares. Briefly explaining our forecast outlook, we expect third quarter result to show marginal year-on-year growth, but it will be a weaker quarter compared to the second quarter in this year, mainly due to seasonal effect and adverse weather condition caused by the cyclone. However, with the rebuilding activities starting, we expect gradual demand growth from the current quarter onwards. Initially, our main investment catalyst was the gradual recovery in the construction activity, mainly driven by the private sector. Now, on top of this, we see additional demand from post-cyclone rebuilding activities. We believe this demand will not be limited to 1 or 2 quarters, but will create a multi-quarter demand cycle for the cement industry. As the market leader with the largest capacity, we believe Tokyo Cement is well positioned to benefit from this trend, which should drive earnings growth over the next 2 years. Anyway, there are some risks to consider, including competitive pressure in the cement industry, interest rate sensitivity, and slow than expected rebuilding activity, which could delay volume and capacity utilization recovery. So that's all about Tokyo Cement. Let's move on to our next pick.
Yeah. So next we have ACL. So we have been recommending ACL for some time, and our bullish stance remains firmly intact. In our earnings review release last week, we have arrived at a target price of 154 rupees, which 81% upside based on 30th December market prices. So even after increase in prices within the last few days by around 20%, the stock still offers a meaningful upside of more than nearly 50%. So nothing to worry. There is more way to go. From a macro perspective, construction growth remains very strong. As per the GDP estimates during third quarter, construction sector recorded 12% growth and PMI readings consistently above 60 levels, sustain expansion in construction activity. So these tailwinds are already evident in the ACL recent quarter top line performance, and we also expect post-cyclone reconstruction activity is expected to provide an additional demand boost in the near term, especially during the fourth quarter of financial year 26. So if we focus on the company-specific catalysts, ACL is very well positioned to capitalize on this environment. Despite fulfilling the increased demand in recent months, capacity utilization still remains around 60%, providing enough headroom to meet incremental demand without requiring major short-term capex. So more that, most special thing is ACL Cables PLC already secured orders for the next 6 months from the Ceylon Electricity Board, sufficient orders for the next 6 months from CEB. So in addition, ACL and its subsidiary, Kalani Cables, command a dominant market position, 70% market share in local market, so supported by the largest dealer network in the industry, enabling effective penetration across both institutional and retail market segment. So on pricing, so we have concern. So on pricing, we expect clear reversal from last year's price reduction. So copper prices have increased sharply and are now approaching USD 13,000 level. So ACL will transfer some of these cost increases to the customers. So they have the ability. The entire industry is dominated by the local players, ACL, Kalani Cables, and Sierra. So they will pass some of this cost incremental to the customers. So overall favorable macro conditions, strong demand visibility, emerging pricing tailwinds, dominant market positioning, and opening operating leverage without near-term capex continue to underpin our positive outlook on ACL. So moving on to the next counter, Sierra Cables PLC. So turning on to Sierra, we have assigned a tentative target price of 40 rupees and 70 cents based on our PE-driven valuation, based on the financial year 27 expected earning per share of 6 rupees and 61 cents, applied by the 5-year average P multiple of 8.8 times with 30% discount. So based on 30th market price, there was around like 24% upside, but it has somewhat reduced because of the price increases within the past few days. But still there is upside. Operationally wise, Sierra operates with lower capacity and market share compared to the ACL group, but their strategy is a bit different. They are mainly focusing on the they are mainly focusing on the project market. So where there are less intermediaries, so they can get better margins compared to highly focusing on the dealer market. They also exist in dealer market, but their primary focus in the focus is on the project market. So they also had some enhanced their capacity recently, and they also concluded some of the notable projects within the past few months, including Cressidia Resort Apartment and Residences by Homelands Skyline, Oceania Beach Resort Apartment and Villas in Vadua, and City of Dreams. They also contributed to the City of Dreams project. So this project-led demand mix supports the margin stability by enabling more direct distribution and limiting the reliance on intermediaries. They also now focusing on the export market. So they are also planning to export more products onto the USA, Asia, Eastern Europe, and the North American region. So with all that, we are really positive on Sierra Cables PLC as well. So that's all about the cable sector. We can now move into the central industry. Over to you, Vinith.
Thank you, Ranga. So, looking at Center Industries stock, where we see an upside potential of 24.4% of the market price as of December 30th, with a target price of 315 rupees. So, following the Ditwa disaster, demand from the reconstruction sector has increased significantly, particularly for PVC pipes and water fittings, and which directly benefits Central Industries as a market leader in the segment. So, Sind secured a majority of government tenders last year, which was around 90% of tenders, strengthening their track record and execution capability. So this places the company in a strong position in win large-scale construction and infrastructure tenders again this year. So this will have a positive improvement on their top line definitely. And looking at the allocations under the 2026 government budget, it's a bit more towards construction and infrastructure, and it's expected to support volume growth and earnings for Central Industries. So, however, key risks remain, including import cost pressures, geopolitical and supply chain disruptions, and competitive pricing pressures within the industry. But overall, we remain positive about the stock given its strong position. So that's about Center Industries. Shalini, you can take it from here.
Yes, moving on from the construction sector to consumer counters, Hemas has been a steady performer in our recommended portfolio from last year. And we continue to have Hemas in our portfolio with a buy recommendation with a target price of 45 rupees. So what drives our recommendation is that in the near term, we see that the demand could spike in the post-disaster recovery period. But in the long term, we see that the growth will be anchored to the underpenetrated segments, mainly the beauty, sanitary napkins, baby diapers. Those are the key underpenetrated segments that they are focusing on. So these segments offer great opportunities for offering premium products and improving the margins. And given the current scope of these businesses, it offers a greater potential in terms of growth. And when it comes to Hemas's healthcare segment, which is one of their key drivers, we believe that the demographic changes in terms of the aging population in the country, as well as the high prevalence of non-communicable diseases. So these factors would be driving the growth in terms of pharmaceuticals as well as the hospital segment of Hemas. So those would be the key drivers in terms of Hemas Holdings PLC. And moving on to our next pick, CIC Holdings. So we believe that CIC's solid fundamentals have left room for further re-rating. We included both the voting and non-voting shares in our recommendations. Of course, the voting share price has moved up a bit and has come to the whole territory, but we still see a potential in terms of the non-voting share. So when it comes to fertilizer, we say that the straight fertilizer margins will continue to see pressure, but the focus will be on these efficiency improvement initiatives that CIC has been taking in terms of paddy or tea, maize, etc. These initiatives have helped to improve their margins, and they will continue to focus on these segments. And the outlook for healthcare also looks bright in terms of the potential for the novel therapies of pharmaceuticals, as well as the export potential for Link Natural, which is the key product, key export product that CIC in CIC's portfolio in terms of their herbal healthcare. And construction activities are picking up. So along with this pickup in construction, we also see a bounce back in the export industries. So these two factors coupled together, we expect to increase the demand for the industrial solutions products and to improve the profitability of the industrial solutions segment. So we of course, in terms of the key risks, any erratic weather conditions or regulatory changes and extreme exchange rate volatilities could have an impact in terms of the risks. But still, we believe the CI's non-voting share will have a 16.8% upside on the current market price. So let's move on to the next counter.
Yes. So moving on to the Distilleries Company of Sri Lanka PLC. So at the time of publication of our strategy report, we had a buy recommendation on distilleries. However, following the recent share price appreciation, we rerate the stock to a hold now. However, the distilleries investment case continues to be supported by its dominant around 70% estimated market share in Sri Lanka's hard liquor segment, underpinned by strong brands and pricing power. As macroeconomic conditions normalize, we expect sustained hard liquor-led volume recovery, supported by improving consumer sentiment and disposable incomes. So most importantly, in case of distilleries, due to their strong market leadership enables effective cost pass-through and supporting margin resilience despite ongoing tax and fiscal pressures, especially on seen industries. So considering all these catalysts, we derive a FY27 target price of 67 rupees, implying around 6.5% upside and expected total return, including our dividends of 3 rupees and 20 cents, we expect approximately 11.6% total return for distilleries. With that, we can move on to other counters as well.
Yes, thank you, Maheshi. So from the financial sector, the commercial bank, so from banks, commercial bank, leading private sector bank, when we released the strategy report, we had more than 15% upside, but with the recent price increase, it has come to the whole territory. Our target price per commercial bank voting is 239 rupees. Driven by key factors, one, we see the immediate provisioning pressure that could be reflected in the fourth quarter and the first quarter initially. After that, probably we will see the full impact. So on prudent basis, we have had forecasted provisionings 1% of gross loan net loan book, which is going to be the conservative assumption at least this stage. And also any kind of rebuilding led loan growth should be reflected in the books going forward. So we expect the credit to pick up and then the NIMs to stabilize around 4.2%, which will be giving consistent earnings going forward. Similar to HNB non-voting as well, we had the buy recommendation as 31st December. Now that it has come to a whole territory, 12.2% upside is there. Again, the similar kind of catalyst being same banking sector counters. Again, with them, they have a stage 3 provision coverage quite high level, 76%. But now with the stage 3 loans, may see a spike so that the provision cover will be slightly lower. In that sense, probably you will see the provisioning kicking in, and that might see a early dip in the earnings, but once that normalizes, we should see the normalized earnings momentum continuing in the banking sector as well. From NBFI sector, we have commercial credit and finance. Even with the recent slight price increase, we still have a decent upside of 26.7% and a target price of 165 rupees. This is even after accounting for increased impairment provisions. They are one of the highest NIM earners in the industry of NBFI, and their ROEs are likely to sustain about 20% even after accounting for these short-term setbacks. With that, although the credit growth can slow down, we believe that the sustainable ROE is likely to keep lucrative upside even at this discounted forecast. So in that sense, we have arrived at a buy recommendation on commercial credit and maintain our buy recommendation going forward as well. So over to you, Shalini.
Yes, moving to HECAB PLC. We maintain a target price of 136 rupees with an upside of 18%. With the key catalyst, if we go through the key catalyst, we believe the gold price upswings that we saw very recently will be sustained for in the near term, and this will be a catalyst for the carbons, given that especially the gold recovery segment will perform well in the event of high gold prices. And value addition. So the value-added products in the last financial year contributed to about 25% of the total top line. And this is expected to grow to about 30% in the medium term and even more thereafter. So what's important about the value-added products is that they are different from the generic offerings and can fetch higher margins and contribute in terms of premium pricing. With their premium pricing, they can fetch higher margins. So in terms of supply chain, as you know, their key raw material is the coconut shell carbon. So in the recent past, there were difficulties in terms of obtaining this raw material as well as the high price of coconuts. So we saw the easing of coconut prices somewhat with improved volumes, and this will help to ease off some supply chain pressures of HECAB. And so the key risks for HECAB remains the gold or any volatility in the gold prices and the supply chain constraints for coconut, exchange rate fluctuations and geopolitical trade risks. But we believe HECAB is well positioned to face to tackle these risks, and is definitely a pick for your portfolio in the long run. So let's move on to our next pick, which is Digital Mobility Solutions PLC, or PICME. So again, when we released this report, we had an upside of over 15%. So our target price is 176. So with the recent price movements, our rating has moved to hold. So what's with PICME is that they have a strong market positioning, and there is potential given the multiple service verticals that they offer within their platform. So they have a very high operating leverage, which offers a greater scalability. So they are very asset light and digital platform. So compared to the incremental costs, they can grow at a much higher pace. And currently, their focus is on increasing the app penetration, because strengthening the network in terms of the users or the riders as well as the drivers is the key at the moment, rather than going to increase the revenue per user. But at this point of time, that is the best strategy, because they can improve the penetration of the app. And in the long run, with this cross-selling of different services through their platform, they can improve the revenue per user in the long run. So that offers a lot of potential in terms of their long-term growth. So over to you, Maheshi.
Yeah. Yeah, let me walk you through the final pick of our recommended portfolio. So that is Chevron Lubricants Lanka PLC. So when we are talking about the lube outlook, which we believe that it remains balanced with improving demand recovery offset by slower volume traction. So lubricant demand is gradually recovering alongside with economic rebound supported by improving consumer spending, easing vehicle import restrictions, lower fuel prices, and strong industrial and tourism activities. So when we are talking about each segments, the retail automotive segment, which contribute around 70% of the top line, remains as the key driver, underpinned by largely 2 and 3-wheeler fleet. And although there is some EV penetration that is comparatively lower, which supporting stable retail demand. Meanwhile, infrastructure and industrial projects provide medium-term upside, particularly from this post-cyclone reconstruction activities subject to securing key government and private sector tenders. So considering these catalysts, we based on the weighted average valuation of DCF, DDM, and PER valuation, we maintain our whole recommendation with 2026 target price of 198 rupees and 75, implying around 8.6% upside. And also we expect Chevron Lubricant to remain as a continuous dividend payer. And however, we see some downside risks such as fluctuations in base oil prices, climate changes, and government policy tender award policy changes, and inconsistent export market performance can affect on the performance of Chevron Lubricants going forward. So with that, I think that brings us to the end of our presentation. I think we can move on to Q&A session. Over to you, Shalini.
Yes, we have received several questions on the Q&A tab. Let's start off with this. Given that the inflation rate is expected to exceed CBSL's target of 5%, how likely is an interest rate hike, and what will be the expected outlook for the listed primary dealers? So let's put it towards Heshan. And the question continues, they have paid considerable dividends. So will they continue to do so this year?
Yes, sir. Yes, sir. Thanks, Shalini, for that question. Now, as Maheshi also explained with her macro projections, yes, there's a likelihood that the inflation will be slightly higher than what the CBSL is targeting. But any kind of CBSL management with inflation, they tend to allow a certain deviation up and down. So beyond that, material deviation are likely to be managed by any kind of interest rate guidance. So we believe that although it's likely to exceed what Mahesh was expecting was 5.8%, in that sense, given that we are in need of stimulating our economy, unless that goes overboard and out of hand, we believe that it's less likely that there will be a rate hike. But if in the event, if the inflation exceeds the expectation and go beyond from a material deviation, of course, the CBSL will prioritize stabilizing the price levels. So in that sense, yes, the possibility of a rate hike, we don't rule out. What we say is it's likely. In that sense, when the interest rate increases, of course, the primary dealers, from what they have in their books as treasury bills and treasury bonds, when the rates reverse, there is a capital loss that is going to play, a fair value loss that will likely to be resolved. So in that scenario, of course, it is unlikely that the earnings will be somewhat similar to what they have recorded in the last few years. Anyway, we have seen the normalization of earnings in the past few quarters and the last few years. Yes, the dividends have come in, could be accumulation of last few years. But in terms of earnings, we have been keep reiterating that earnings are likely to be normalized. So yes, the earnings are going to be normalized, won't be the same high as the last 2 years. In that comparison, the dividends, yes, it has come out in strong accumulation, but going forward, there is a tendency that could also normalize when the earnings normalize, although payouts are high. So in that sense, yes, you can expect some sort of a normalization in terms of primary dealer earnings and the dividends going forward. Having said that, it's all up to the management discretion and management expertise of forecasting earnings rates volatility. From that, whether they can manage some sort of earnings, it's up to the, we have to see. But from our general view is that it's likely to be normalized going forward.
Yes, thank you, Heshan. And the next question is on the cable sector, and I will direct it towards Iranga. Why is ACL favored in comparison to other listed cable companies?
Sorry, I couldn't hear you. Sorry.
Yeah, why is ACL favored in comparison to other listed cable companies?
Yeah. So the main thing is their market leadership. Along with the Calin cables, they are accounting for around 70% of the local market share. They also has a considerable exposure to the exports, so they are receiving sufficient dollars even for their importing activities. On top of that, they have their production facility. If we consider about their production facility and relationships with CEB, so they are in a good position. Just like I mentioned, they are already secured the orders from the CEB for the next 6 months. So all those things are highlighting ACL has a strong earning potential. So that's why I'm favorable over other cable companies, but that doesn't mean other cable companies are not good. Even Sierra are really doing well. Just like I mentioned, they are effectively using their limited capacity. Even they have additional capacity because they are flowing with orders. Their current capacity is not enough. So they have done few modernization to their current capacity, and they also getting sufficient orders, and they also now focusing on the export market, especially on US market, Africa. So those countries, they are focusing on those countries as well. So overall, I'm positive about entire cable sector, but in our core coverage, we are mainly focusing on the ACL, and we also add Sierra in our strategy report. So we are focusing on those two counters, but there is no any like I'm saying others are bad. Entire sector is good. Construction sector will grow.
So thank you, Viranga. Next is on AEL. Maheshi, if you could share the AEL slide once again, I think that will also be helpful. Comparing with the MAGA, has AEL received significant tenders from the government from on the reconstruction?
I think let me share my screen.
Yes, because there was a request to share the AEL slide once again as well.
Okay. Okay. I'm not sure. Hope my screen is visible to you. Is it visible or?
I think it's coming on. Yeah. No, not it. You can answer the question.
Yeah. Yeah, appreciate if someone can share the screen for the AEL. Yeah, while sharing the screen, I will give you the answer for the question. So I think the first question is about comparison between MAGA projects and AEL. So I don't think we are not in a position to give you a proper comparison about MAGA projects and AEL right now. But what I can tell you is AEL has more hands-on experience in most of the infrastructure projects, including housing projects, transportation, port, aviation, all these segments, bridges, marine projects, everything. So I think so. Since although we don't know how the tenders will going forward, whether they will offer or not, I think we are not in a position to comment about that. But what I can tell you is Access Engineering is well positioned in the infrastructure segment, construction segment. So they have, with the hands-on experience in all these public infrastructure, they have additional advantage in receiving all these projects. That's what I can tell you at this moment. And about the question about the target price, so at the moment, we have given tentative target price of 97 rupees. Actually, this is based on price earning ratio valuation method. So based on that, we have given 97 rupees target price for 2020, FY27, with upside of around 25.5%. I hope I answered your question.
Yes, thank you, Maheshi. And the next question on the expectation of the ASPI achievement, I will direct it back to Heshan. What are the expectation of ASI achievement and related resistance and support levels?
Yes, actually, that's a very valid question, and it's something we have thought about carefully as well. Now, one thing is that in terms of support and resistance level, yes, I may be able to give a better idea. Yes, of course, in terms of resistance, since it's a kind of a high level, we have to do some sort of extra advanced analysis level to find out the resistance level. But on maybe psychological level, maybe initially it would be surpassing the 23,500 level that we have forecasted, and probably heading towards 24,000 on a more psychological note. In terms of support level, we have seen around slightly below around 22,000 to level and 21,500 from our base bear case scenario. Those could be the areas that that could be potentially looked at as support and resistance level. But in terms of target price or the projections for ASPI, let me clarify and maybe give you a different taste of what we have been thinking in terms of arriving at our projection. So our fair value is based on a justified PE multiple of around 11 times, which we view as a prudent and a conservative assumption, looking at the 10-year average. However, all these are subjective, and if market participants are willing to assign a higher multiple, it's about time that we re-rate our Sri Lankan multiple to a higher level, but it should come structurally what we feel. If we had to attribute a 12 time, as we have given our scenario analysis, the SPI could be in the range of 25,750 from our theoretical fair value. And at the same time, you can look at the 1 year forward earnings and then attribute that into the multiple, and then say the SPI projection of 27,000 is actually should be at the end of 2026, a different way of looking at it. But in our view, we believe that we should look at the short-term volatility in earnings that are going to be the fourth quarter results are going to be anyway a dip. It was supposed to come down because the ISP gains from the banking sector is not there anymore. And then the one-off gains from LLC group, those also will normalize. However, this cyclone Ditwa impact also will materialize in the fourth quarter and the first quarter. So all these short-term impacts also should be a reflection. That's why, because of those reasons or risk factors, we have applied 11 times. But it seems that the market is willing to look beyond these short-term setbacks and attribute higher multiples. In that case, obviously, you can look at a more bullish multiple of 12 times. But at the moment, we are attributing 11 times, and we tend to look at the maybe slightly beyond the second half of 2026 and look at this 2027 target of ASPI for a better projection is what we feel.
Yes, thank you, Heshan. So we can take in couple more questions. How about the impact from Helago? I think this is the with reference to PICME. So I will take that on. So I think when it comes to these ride-hailing companies, the most important thing is the network in terms of the riders and the users. So both needs to be available in order for these companies to succeed. And PICME has over the years has established a strong network. So it will be, I'm not saying impossible, but it will be difficult or rather, it will take some time for another competitor to establish a strong network. So, of course, healthy competition is good for the industry and it will help to sort out issues that within the company and to give a more efficient service to the consumers. So, in the near term, I don't think there will be a major impact coming in from the new players. So there is another question related to the apparel sector. Iranga, can we expect any positive impact to MGD, TJL, Heller in 2026?
Yeah. If I talking about this apparel sector again, I have to speak bit companies specifically. So for the moment, let's focus on the MGD and TJL. Or first, we take the TJL, which counter which was under our core coverage. So we recently have given a sell recommendation for the TJL, considering the few concerns, especially TJL has their biggest production capacity in India. So USA has imposed additional tariff on Indian exports, Indian apparel exports. So that has impacted negatively on TJL. Even that was visible in the recent financial reports, and the company also expecting the USA will remove this additional tariff on India, and things will get better. But as per our expectation, we are not expecting such a scenario within the recent future. So they are still looking at something. The USA will remove the tariff and things will get better. So for the time being, we are not expecting such a thing, but they are also doing certain things to improve their margin. Just like now they are focusing highly on this renewable energy, and the LKR also, the Sri Lankan rupee also depreciating a bit. So those will add some aid for the TJL, but what I feel is those are not sufficient to like provide to overcome this situation. So that what I feel, if their production facilities are only in Sri Lanka, still things would have much better. But their biggest production capacity in India, so that is adversely impact on them. If we focus on the MGD, unlike TJL, their entire production capacity is in Sri Lanka, but their production capacity is very limited. But they also have kind of a customer concentration risk, what I feel. The last quarter, though their entire production facilities are here, they also recorded a strong decline in their top line. So what I feel this due to this customer concentration risk, if one or two of their customers decline the orders, then they are highly impacted. So in such a scenario, for the time being, what I'm recommending is focus on other counters for the time being. I'm not saying don't invest in the apparel sector counters. If I feel the prices will come down further on that, at that point, you can make a decision whether to buy at these discounting prices and make a gain when the things are getting improved. But for the time being, I feel prices will go down further. What I feel.
Thank you, Viranga, for your insights. And we can squeeze in one more question, I think, one on Chevron lubricants to Maheshi. How do you view the sustainability of Chevron's dividend if LKR sees some devaluation leading to higher oil prices in rupee terms?
Yeah. Actually, in our model, usually we see the oil futures and we factor that cost pressures. We anticipated some cost pressures and factored that in our model already. So I think, yes, there will be some pressures if there is any rise in oil prices while we are having some gradual depreciation in exchange rate as we expected in our macroeconomic outlook. But however, I can tell you regarding the dividends, of course, Chevron Lubricants remained as continuous dividend payer, except for the crisis period. We have seen some setback in paying these dividends, but again, they started paying it. So we already in our portfolio also, I think we always recommend Chevron Lubricants as an dividend payer. So I think Chevron will remain as a continuous dividend payer with a high payout ratio as we forecasted in our earnings review as well.
Thank you, Maheshi. I think with the time constraints, we will conclude the Q&A session now. So that brings us to the end of the first webinar for 2026 conducted by Bartley Treligas Securities on our 2026 macro and equity strategy. So we thank you all for staying with us throughout. Stay tuned with us for future events and have a good evening. Thank you.